All right, so Joe, I want to ask you, obviously tomorrow's a holiday, half day on Friday, then we have the last month of the year. The action we've seen in November so far, do you expect that to be a sign of what to expect going on for this last month? Healthcare and leadership, investors being a bit more picking and choosing when it comes to AI.
Look, I think overall, the personality of the market has changed. I think it's going to be a little bit more difficult, a little bit more complicated, a little bit more idiosyncratic. I think we're going to screen out some of the participants in what has been a very strong thematic trade surrounding AI and look at what the valuations might be and say, okay, we're more comfortable with something that has a reasonable valuation. But I think in the near term, we kind of, over the last 2 weeks, we stepped on the animal spirits. It looked like we wanted to take the market lower. In fact, we actually held the 100-day moving average. And where are you today? You have a VIX below 18, which is its best level in the last 2 weeks. So it looks like in the near term, we're kind of pointing back towards that all-time high for the S&P. And I think what I like about what I've seen so far this week is the participation is broad-based. The participation, once again, it's not like you have to pick between, do I want to be in the S&P or do I want to be in the S&P equal weight? They're both rising right now. We're seeing various sectors that are appreciating as well. And it looks as though with that type of improvement in sentiment, you could challenge the previous all-time highs.
Yeah, to your point, all sectors, week to date, it's a holiday shortened week, lower volume, but all sectors are in the green. So Liz, really the same question for you. In November, we saw healthcare take leadership. We saw investors picking and choosing when it came to AI. We may be seeing Alphabet take some leadership. Is this a sign of what's to come for the rest of this year?
Well, so the rest of this year, what we're doing then is setting up for what we're looking at in 2026. And as we know, January is usually a pretty strong month for the markets. But what I've found interesting after this pretty strong breakdown in beta that happened over the last month or so is how the leadership has shaped up coming out of it. So when you look at last week's lows, Thursday we had that big turn from being up and then down. From last week's lows, the sectors that have been the strongest coming out of it, we've got healthcare, materials, and consumer discretionary. Tech is not on that list and one of the strongest coming out. So now I think investors are searching for, number one, as Joe mentioned, more attractive valuation. So you can think of that however you'd like to, whether that's value-based sectors or things like growth at a reasonable price. And then looking at more opportunities for beta opportunities going forward, what's going to produce some of that return. Healthcare has been such a bright spot, even since August, if you look at performance of healthcare since August. So I think that will continue for investors searching for ways to make money outside of a lot of the darlings.
Yeah, to your point, healthcare by far the best performing sector this quarter. For multiple months, it's been kind of moving higher. I want to talk about something else you're talking about here, the rotation out of tech. If you go look at what Bank of America put out last week, when it comes to tech, rolling 4-week average of tech outflows as a percent of market cap at 4-year extremes, going all the way back to 2021. Jason Snipe, with that in mind, last week at least, investors were getting out of tech. What are you expecting going forward, again, for today, holiday shortened week, but also for the month ahead, for December?
No, I think seasonals could be at play. I think, one of the things we haven't mentioned yet is obviously we heard some Fed speak this week from Daly and from Williams that were more dovish in tone, which I think has been accretive to the market and some of the movement. Also, the price action has been positive. We saw regionals move, transports move, home builders move. The Russell 2000 is up 5% in the last 5 trading days. So to Joe's point, I think breadth has been positive. And healthcare, healthcare being the leading sector this month, up over about 10%, which I think has been positive in terms of the cyclical rotation. So I think this is all generally good. I think we needed to take something off the boil as it related to tech. And, now we're getting a little bit of a bounce. And I think this is all healthy for the market going forward.
All healthy. By the way, Morgan Stanley out with a note, and Weiss, I want to bounce this off of you when we're talking about tech and some of that, the bond issuance and everything else. They went on to say, I'm just going to summarize, we're not going to show the whole thing. The primary risk of the AI capex boom is a failure to deliver productivity in a timely manner so that leverage rises faster than output. We were all here when some of these bonds were issued. We kind of talked about and debated it. Snipe, you were here too. Yep. I mean, really, is that the risk going forward, that we're going to see more of these bonds coming out, kind of shaking confidence in this trade?
No, I don't think so. First of all, I want to point out one anomaly today that has me greatly concerned. Joe's ties askew, his collar's unbuttoned. I don't think I've ever seen that before, and I find it very
Something's
disturbing.
going on.
I will fix it.
No, look, that's just the latest one trying to come in and say, in a very guarded way, sitting squarely with their butt in the middle of the fence, is there a hole in the AI trade? Now, we're not, you've got to be have your head in a hole if you're not seeing productivity gains already from AI, and we hear about it every day. Then in terms of the balance sheets, tech, if I had to pick a sector where I didn't mind leverage, that would be in technology because of their cash flows, their free cash flow generation, et cetera. We never talk about it with airlines. We don't talk about it with capital-intensive businesses. Granted, they're at much lower multiples, but the risk is much higher there because of the various volatility in their businesses. I'm just not worried about it with tech, and I applaud the use of leverage because leverage leverages your returns. So that dialogue's got to go away. Now, some companies like a CoreWeave or maybe an Oracle, because they've taken to such a degree, maybe that's a different issue. It is a different issue, but it's not an issue with any of the other tech trades. So I wish that would just die a quick death. So I think that the market's going to revert to where it has been. We're having the same conversation that we had in April. Is this it? Is it over? The answer is it's not over. Valuations now more reasonable, but I expect them to once again lead next year.
All right. Joe, last week we were talking about this, kind of the correlation between equities and Bitcoin. Yes. Apollo's Torsten Slok out with a note today, some other people out with a note looking at the divergence. NASDAQ and Bitcoin usually highly correlated. There's been a divergence, kind of Bitcoin moving lower, the NASDAQ able to move higher. What does that say about this final month of the year or investor sentiment? Has some of that margin buying been washed out? Is that what we're seeing here when we see the NASDAQ able to move higher even with Bitcoin moving lower? Is there something else taking place?
I think it's indicative of that there were technical forces at play, whether that was reducing leverage and obviously seeking liquidity in the marketplace as it related to cryptocurrencies. It wasn't really about fundamentals. So all you really needed was more stabilization than a reversal and a move back higher in cryptocurrencies for equities to kind of say, okay, we can now continue the prevailing overall bullish trend. And I think that's what's happening. It's interesting because in the technology trade, and I think Steve makes some really excellent points, just because Oracle has a debt to equity ratio of 550%, that does not mean you overall assign this universal negative viewpoint on the usage of debt by others in the AI trade, because their debt to equity ratios are much lower. So, if Amazon's going to go out and do a $27 billion private deal, if Alphabet's going to do $25 billion, if Amazon's going to do it, that's fine. You can be comfortable with that because you're talking about reasonable debt to equity ratios. In the case of Oracle, Scott has been asking us on a daily basis, and I applaud him for doing so. Okay, we all know you're in Oracle, but right here, what would you do it? And the answer to that has been no. It looks like it's a falling knife. Well, now you have this 4% rally today. You have a little bit of a gap higher. You have that low at 185 from the other day. So if you have not entered into Oracle yet, and you want what can be a low-risk trade with a point of reference attached to it, you're utilizing that low at 185 as a stop-out point, maybe to go in here and buy some Oracle.
So you mentioned Scott's been asking that question, what do you do with Oracle? You own it. Jason, you own it. So we might as well ask you one more time where it's at right now, up over 3.5%. What would you do with Oracle right here? How attractive does it look going forward for this last month of the year?
Yeah, no, to Joe's point, I think it is attractive here. I think the concern, of course, is it's a $570 billion company with north of $100 billion worth of debt. And I think that's been the concern around the market. Listen, it's down 37% since that, when we were on the air and talking about that 359% RPO growth, and the stock was up a ton.
We haven't talked about that RPO number in quite a bit.
We haven't.
Quite a bit.
For good reason, right? Because of the price action. But I think this is an interesting place to enter. We'll see how they deal with this OpenAI deal, if they're able to hit these commitments. But I think with Larry Ellison behind the helm, I think they can be successful going forward. And that's why I think this is an attractive point here.